For more on overseas markets right now, we're joined by Ashraf Laidi. He's Chief Executive Officer of Intermarket Strategy, and he joins us from London. Ashraf, good to connect with you again. Let's talk about the most recent numbers out of China, the weak inflation numbers, the weak producer price numbers coming out of China. The second consecutive day that we've had disappointing numbers out of China, and the second consecutive day that we're seeing a fairly significant market reaction to those numbers. How important are they?
Well, the inflation numbers, Paul, I mean, they're important, but they're not as important as the 11th consecutive monthly decline in Chinese imports. We've been pointing out to the clients since January of this year, and when the trade data comes from China, don't look at the trade balance, don't look at the exports, look at the imports, which measures the purchasing power of the nation. Back then it was down for the third or fourth month. Now it's down for the 11th month. What that really means, Paul, is that now that the Chinese are out from the G20 shindig from Ankara, they're back from Lima. Yes, they're going to visit the UK. When they go back, they're going to go back to what is going to be, which is to gradually depreciate the Chinese yuan. Because the fallout in China from the metals, what happened in the metals and all the carry trade to do with that, is not done yet. So I think that we're going to see further a gradual depreciation in the Chinese yuan. And there is going to be ongoing pressure on the commodities, mainly on oil and less so on metals.
You make a point in your most recent note that it's important to understand what Chinese imports are reflecting. And you say it's not a slower pace of domestic consumption. It has more to do with infrastructure spending and a weaker global economy. Just explain that to us.
Well, yeah, I mean, if China is the engine or is the engine that could, or it's one of the biggest importers of the world economy, then, you know, there is no better measure. There's two main measures of China's purchasing power. One is the currency, which was depreciated in early August and expected to fall more. And the other one is the imports. And some people look at, they say, well, if you look at China's imports, you're looking at the yuan or the dollar value, and it's not as a big deal as volumes. Volumes are stabilizing, they're not falling as much, but I think they are continuing to fall. Just to give you a perspective, Paul, during the crisis, 2008-2009, Chinese import fell for, I believe, 13 consecutive months. So we are down 11 consecutive months. Again, this is the story that the guys in Washington, in Constitution Avenue, in the Central Bank of the United States, those who say that China is not a problem, it's not a major problem, it is a problem. And we've been telling clients that falling oil is a problem because it exceeds the wealth effect that you and me and her and him have at the mall. Okay, the capex, when capex falls, the fallout from there is a big deal. And it is also felt in China. So basically you tie that together, and it's the story that I've been saying, and like a broken record, the Fed is not going to raise interest rates. And finally, the sensible people from the Federal Reserve, the Brainard and the Tarullos are basically saying that, look, the fall in the unemployment in the U.S. is not enough to spur inflation. And the Brainard said, just to put it, what Summers said, the tightening in the financial market is equivalent to a couple, that is in English, 2 rate hikes. And that's why the dollar is falling, which we've been telling our clients since early August that the dollar peak has happened.
Ashraf, this is Gareth Watson here. I've just got a quick question going back to the response from China. You talked about a possible further yuan devaluation, but do you have any expectations on the fiscal front or monetary policy front with respect to interest rates and the bank reserve ratio requirements, where those could be headed here in the next few months?
They will be heading lower. I mean, you know, they were resorting to channels of RRR, reserve requirement ratio, and to the lending and the deposit rate, and now they're using the currency as the third channel, which happens every 10 to 15 years, and now they're using all of it. So I think they're going to resort to probably 2 more rate cuts in the RRR and a few more rate cuts probably in the interest rate, not so much, because it's really going to probably kill off the carry trade. They will continue to do so as long as the Fed does not raise rates. But but yes, there is going to be a currency easing, a monetary policy easing, a gradual easing. What they did in the last few weeks, anybody who hears this interview and goes to the Chinese yuan chart and sees the Chinese yuan actually appreciating, and they will be confused, don't worry about that. They were trying to do that in order to stop a fast decline in the yuan, and that's by selling the treasuries. That's why yields were going up for a while the stock market was going down. But now yields are going down, stock market is going down, and we expect that the next 2 weeks are going to see a nice upward correction in the markets before we're going to drop lower by around 7 to 10% in equities from December into the beginning of next year.
Ashraf, good to connect with you again. Thank you very much.
Thank you.
That's Ashraf Laidi, Chief Executive Officer of Intermarket Strategy from London.